A borrower pays nothing this month, no coupon reaches the bank, and yet the private credit fund may still record income and NAV may still increase. Would you approve that? Some candidates say yes, it must be PIK. Others say no cash means no income. Both answers can be wrong because before posting anything, you need to understand the loan agreement, the type of interest, the reporting entity, and the borrower's credit condition. In this video, we will follow one private credit loan from funding to interest accrual, PIK, missed payments, valuation review, repayment, and investor reporting. And by the end, you will have a practical framework you can use in an interview or month-end review. Assume a private credit fund provides a $10 million loan to a company. The first question is not the journal entry. It is, who is legally making the loan? Is it the main fund or an SPV? That matters because the cash, loan asset, and interest must be recorded in the correct entity's books. Now assume the fund itself transfers $10 million to the borrower. The basic entry is debit loan investment $10 million, credit bank $10 million. Did NAV fall because cash left the bank? Normally, no. Cash became another asset, the loan investment. Cash falls, the loan asset rises. This is generally an asset swap, not an expense. Loan funding is not the same as loan expense. But what about upfront fees, original issue discount, legal costs, or arrangement fees? There is no single entry that applies to every amount. You must ask who paid it, who earned it, is it directly attributable to the loan, and what do the accounting policy and loan terms require? That is lesson 1. Understand the economics before proposing the entry. Now move to month end. Assume the loan carries 12% annual cash interest. On $10 million, the monthly interest is $100,000. If the interest has been earned but not yet received, the fund may record debit interest receivable, credit interest income. Cash has not moved, but income and NAV increase and a receivable appears. When the borrower later pays, the entry is debit bank, credit interest receivable. That cash receipt does not create income again. It only clears the amount that was already accrued. Interest accrued is not the same as cash received. Now let us look at PIK interest. PIK means payment in kind. Instead of paying interest in cash, the borrower may be contractually allowed to add it to the outstanding loan balance. Assume the loan carries 8% cash interest and 4% PIK. The PIK portion may be recorded as debit loan investment or a separate PIK receivable depending on the accounting policy. Credit PIK interest income. No cash arrives, but the loan balance, income, and NAV may increase. That can be completely valid if the agreement permits it. Here is the trap. A missed cash payment does not automatically become PIK. The borrower cannot simply fail to pay and have the accountant relabel the overdue coupon. You must check, was PIK permitted? Was it elected correctly? Was the amount capitalized under the contract? Or is the payment simply overdue? PIK interest is not the same as missed cash interest. Now imagine the borrower was required to pay $100,000 in cash, but nothing arrives. Should the fund continue accruing? The weak answer says yes, because the contract says 12%. The stronger answer begins with questions. Has the due date passed? Is there a grace period? Was cash received shortly after period end? Has the borrower disputed the calculation? Is unpaid interest contractually convertible to PIK? Has a waiver been granted? Is the loan now past due? And what does the credit team know? Suppose it was only an administrative delay. The borrower paid shortly afterwards and the business remains healthy. The amount may still support an interest receivable. Now change one fact. Two payments are missed. Revenue is falling. A covenant has been breached. Management is asking lenders for relief. Can the fund continue recognizing income exactly as before? Possibly, but not automatically. Because at this stage, accounting can no longer be reviewed separately from credit risk and valuation. Can a private credit fund record interest income and reduce the loan's fair value in the same month? Yes. Interest income reflects what accrued under the loan terms. The valuation movement reflects updated credit risk, collectability, and expected recovery. For example, the fund may record $100,000 of interest income and a $1 million unrealized loss. Income increases NAV by $100,000. The markdown reduces NAV by $1 million. Net result: NAV falls by $900,000. That is why accrued income is not always collectible income. A reviewer should never assess interest separately from the borrower's credit condition. Now consider a covenant breach. The breach does not give you the journal entry. It tells you to investigate. Was it technical or financial? Has it been waived? Did the interest rate change? Was default interest triggered? Can repayment be accelerated? Has expected recovery changed? And has the valuation team used the same information? A strong reviewer connects accounting, credit, and valuation. The loan register cannot say performing while the credit report says distressed and the valuation file assumes nothing changed. Now move to repayment. Assume the borrower repays the $10 million principal in full. The entry is debit bank, credit loan investment. Does that create income? No. It converts the loan asset back into cash. Principal repayment is not investment performance. But suppose the carrying value is $9.5 million and the borrower pays $10 million. That may create a $500,000 realized gain, depending on how earlier valuation movements were recorded. If the borrower also pays a prepayment premium or exit fee, analyze it separately from principal. Cash received does not determine accounting classification. If the fund sells the loan, separate cash proceeds, carrying value, realized gain or loss, and any prior unrealized movement requiring reclassification for performance reporting. Now bring the loan into the month-end NAV package. The reviewer should trace it through the loan agreement, the loan register, the general ledger, the cash reconciliation, the interest schedule, the valuation support, the credit report, and investor reporting. These records must tell one consistent story. The rate should agree with the agreement, the day count should be correct, the principal balance should reflect funding, repayments, and capitalized PIK. Cash should clear the correct receivable, credit events should reach valuation, and the NAV bridge should explain what moved. NAV may rise through cash interest, PIK interest, or valuation gains. NAV may fall through expenses, markdowns, impairment, or realized losses. So NAV increased is never the complete answer. The real question is, what moved NAV and which schedule proves it? Here is the interview framework. For any private credit scenario, answer in this order. First, identify the event. Was the loan funded? Interest earned? Cash received? PIK capitalized? A payment missed? A covenant breached? Valuation changed? Or principal repaid? Second, identify the reporting entity. Is it the fund, an SPV, the borrower, or another vehicle? Third, check the contract. What do the agreement, amendment, waiver, and payment terms permit? Fourth, explain the accounting impact. What happens to cash, the loan balance, receivables, P&L, and NAV? Fifth, connect credit and valuation. Is the amount collectible? Should accrual continue? Has deterioration been reflected in fair value? Sixth, explain the reporting impact. What reaches the NAV bridge? investor statement, and review package. Then and only then propose the journal entry. That is the difference between memorizing private credit and understanding it. The weak answer defines the instrument. The strong answer follows the loan. Now return to the opening question. A 12% cash pay loan misses its scheduled coupon. Would you accrue another month of income? The senior answer is not simply yes or no. First, check the loan agreement, due date, grace period, subsequent receipts, borrower credit condition, non-accrual policy, and valuation impact. Then decide whether the amount remains recognizable and collectible before proposing the entry. If this video helped you connect private credit accounting from funding to repayment, save it and share it with someone preparing for a private credit or fund accounting interview. Tell me in the comments, which topic should I break down next? PIK interest, non-accrual, covenant breaches, or private credit valuation? Follow the Fund Desk for more practical fund accounting and private markets explainers.